This is a High Mount Research Market Insights video for April 20th, 2023. Good afternoon, everybody. Willie Delwich here. Glad that you are listening. Glad that you have tuned in. This is one of our weekly Market Insights videos where we take a closer look at one area of the market. We don't try to summarize everything. Not a lot of portfolio perspectives here. More focused on one of the areas of topical concern. Today, we're going to actually look at the market from the perspective of investor sentiment. So you can see here we've got on screen our table, our sentiment table that we've shown at various times in the past. We look at sentiment across a number of different indicators, three different time frames. We look at from a tactical perspective. There's a question of complacency versus fear as expressed through the put call data, and then also the VIX volatility index. Zoom out a little bit from a cyclical perspective. Here it's optimism and pessimism across the various weekly sentiment surveys, and then also from a flow perspective. So not just what investors are saying, but also what they're doing. And then finally, from a strategic perspective, are we thinking about things from a risk versus opportunity? Here we're looking at more from a positioning perspective, from an asset allocation perspective, and then also from a valuation perspective. So this is a summary table. You can see short-term basis put call data indicates some fear. Volatility, the VIX is neutral at best. We'll get into that in just a moment. Go through the various sentiment surveys, generally neutral right now, but encouragingly moving towards optimism. So we're starting to see evidence that investors are embracing strength. That's a good thing, not a bad thing at this point. And then this transition, this pessimism from a flow perspective, actually raises some concerns from a strategic positioning perspective. We'll get into that. Investors are overloaded with equities at this point. If they start to shift flows away from equities towards fixed income, towards international equities, could become a headwind for equities going forward. But let's look at the charts, get into it. We'll start with the VIX. Broke down this week below 17. That's the lowest level since January of 2022. Seems like an ominous sign. But then if you look back a little further, you say, well, it was low for most of 2021. Go back even prior to COVID, it was super low back then. It is true that the VIX can get low and stay low for extended periods of time. That doesn't necessarily always translate into opportunity for investors. And while we're on the subject of what happened in 2021 and 2019, the VIX is only part of the story. If we combine what we're seeing from the VIX, so low VIX readings in 21 and 2019, those occurred at a time when we were seeing strength in other places. We're seeing our net new high advanced decline line was generally rising over the course of 2019. More stocks were making new highs and new lows. 2021, same story. The VIX was low, volatility had ebbed, but we were seeing strength. Our net new high advanced decline line there, rising generally over the course of 2021. That's not the case right now. The VIX has fallen to low levels, and we're seeing weakness in terms of breadth, in terms of this net new high advanced decline line that is falling right now. So low VIX combined with weakness from a breadth perspective is not a good setup. And then just look at what we've seen over the past year plus. Going back to the beginning of January 2022, when the VIX has been above 28.5, the S&P's returned 15%. When it's been below 28.5, the S&P 500 has lost 25%. Even as it's rallied a little bit recently, it's still cumulatively down 25% since the beginning of beginning of 2022, when the VIX has been below 28.5. And so it's ebbing lower. You have complacency. You don't have strength to support that complacency. It seems more like on the risk side than an opportunity side. Moving slightly further out and thinking about this from a sentiment survey perspective, at the top here, we've got the S&P 500 moving sideways. What we've talked about is wanting to see investors embrace strength, wanting to see the sentiment surveys get above their August 2022 highs. That's where the top line here from a price perspective, that's August. So we're seeing that across in the NAIM exposure index actually surged this week. It had dropped last week in the 50s, almost up to 80 this week. So that it suggests an embrace of equities on the part of investors. Not excessive at this point. It's getting close, but not excessive like we saw in 2021. From a investors intelligence perspective, bulls on the II survey moved above 50% this week for the first time since early 2022. We have the embrace of bulls from an advisory service perspective. You can see is well above where it was in August of 2022. The laggard is individual investors. The AAI survey edged lower. Stayed in kind of that negative territory, more bears than bulls. Again, we'll get into exactly how long that's gone on for in just a moment, but we're not seeing the embrace on the part of individual investors. And yes, it's true that when optimism gets excessive, that can be a headwind for equities. But right now, moving from pessimism through neutral into optimism, that's actually a bullish backdrop for stocks. That's constructive. That's the crowd moving in the direction of equities. That's what we want to see if we're going to have a bull market. It takes bulls to have a bull market. This is just looking at what's happened from an II bull bear spread since 2015. All of the gains, virtually all of the gains in the S&P 500 over that time period have come after the bull bear spread has crossed above 18%. Seeing it move higher right now is what we want to see if we're going to have sustainable strength. If whatever this rally is that we've seen over the past few months is actually the beginning of a bull market, we want to see investors embrace that and move into equities. That's been the pattern in the past. Cross above 18%, stocks tend to move higher until you start to fall apart at the end. But still, even after peak optimism, it's still that all the net gains for this S&P 500 in this time period have come when the bull bear spread is above 18%. Look at this from the perspective of individual investors. You go back into early 2022, probably actually late 2021, and you've had only 4 weeks, 4 instances where we've had more bulls than bears on the individual investors AAII survey. And then in that time period, you've had 66 weeks, I believe it is, of more bears than bulls. And so we need to change this pattern of behavior of persistent pessimism. When that persistent pessimism fades, stocks tend to do well. The problem right now is that we had the persistent pessimism. It isn't fading. It's lingering. That reminds me to some degree of what we saw during the financial crisis, where it peaked around 75%, but then moved sideways for a little bit. It wasn't until after it started to move lower, after investors embraced equities, that we actually saw sustainable strength emerge in the stock market. Expect the same this time. We need to see that embrace. From a earnings revision perspective, analysts had been having to chase estimates higher. We saw these upward revisions. This is the S&P 400 had been the strongest area among the mid caps, have been the strongest among large caps, mid caps, small caps. So focusing on that right now. Over the past month or so, we've started to see fewer and fewer stocks, fewer and fewer companies have earnings estimates that get revised higher, starting to actually turn lower now. If that continues to be the case, that suggests a shift from a macro perspective that suggests risks to the downside, as it turns out that analysts were too optimistic rather than too pessimistic. It's a tailwind when analysts were pessimistic and chase higher. It's a tailwind when they were too optimistic and then did chase with earnings estimates, chase the market lower. From a flow perspective, I think this is really interesting. Looking at ETF flows across US equities, international equities, fixed income last year versus what we've seen so far this year. Last year, US equity ETFs saw more inflows than international equities and fixed income combined. This year, US equities barely positive for the year. That's just due to this past week's inflows, whereas it's international equities, fixed income that are getting the attention. This has potential long-term ramifications for the stock market because we're at a period where investors are overexposed, historically speaking, to equities, underexposed to bonds, and to a lesser extent to international equities. Blue line here shows the ratio between stocks and bonds at the household level. This isn't how they feel about stocks and bonds. This is their positioning, their exposure to stocks versus their exposure to bonds. This is interesting because of the strong inverse correlation that that ratio has with forward stock market returns. That's the orange line. When the stock bond ratio is low, forward returns tend to be strong. That's what happened a decade ago. Elevated levels of bonds, low levels of stocks. What happened? Stock market gains ripped quite strong, 15% annualized returns almost at from 2021 back to 2011. Where are we now? We're at 3 times as much exposure to stocks as bonds. Historically speaking, that suggests low forward returns for equities as investors shift from equity exposure to bond exposure. That flow data, typically, if we're in a period of strength without these sort of secular shifts happening, then outflows from equities, that tends to be a sign of excessive pessimism. In this environment, given what we're seeing from an asset allocation perspective, it feels more like the beginning of a sustained shift away from U.S. equities and towards bonds that could dampen forward returns for the equity market going forward. And so then that brings us back to weighing the evidence. And this is the scales we showed at the beginning of this month. We took sentiment from opportunity down to neutral for many of the reasons that we've just talked about. The complacency we saw from the VIX and the half-hearted embrace of investors as they responded to strength that we saw in Q1 from an equity market perspective. Nothing that we went through today makes me want to change that positioning, change that call. It still feels like sentiment is a neutral influence on equities right now. I'm not concerned by the increase in optimism that we're seeing in some of the weekly surveys. I think that's what we need to fuel a bull market rally if that's going to take place. I'm more concerned with what we're seeing from a short-term perspective, the VIX being so low, and then from a long-term perspective, valuations in the sky and exposure to equities still running quite high. And so that's our market insights video for this week. Glad you tuned in, glad you listened. Try to do these every week where we look at a specific area of the market, break it down into relevant areas, relevant charts, relevant areas to focus on, kind of get rid of some of the noise, focus on the news, focus on what's important. Thanks for listening. Hope you're having a good week. Hope you have a good week ahead, and I'll talk to you again soon.